Did the headlines last week make you think the stock market was falling apart? With news screaming trade war escalates and consumer confidence crumbles, you might have felt a wave of fear. But here's the real story you might have missed. The US stock market actually had its best week of 2025. How can the news seem so bad when the market is doing so well? In this video, we'll cut through the noise and look at the evidence from last week's market performance, key economic signs, and important stock movements. We'll also discuss what this means for your investments and the steps you should consider now. Let's look at the numbers from this past week, ending April 26th. The S&P 500, a key measure of large U.S. stocks, went up a strong 4.6%. The Nasdaq Composite, which includes many tech stocks, saw an even bigger jump, rising 6.7%. Even the Dow Jones Industrial Average, made up of 30 large companies, increased by 2.5%. Looking internationally, developed markets outside North America also performed well, with the MSCI Europe Australia and Far East Index gaining 2.6% for the week and now up 8.4% for the year. So, what caused this strong rebound? A few things helped calm investor worries. First, concerns eased about potential big changes at the Federal Reserve, which helps keep interest rates predictable. Also, tensions over trade with China decreased significantly, with talks about lowering some tariffs. When the risk of trade wars goes down, companies feel more confident about their future profits. On top of that, recent reports showed that people are still spending money and the job market remains strong, which was better news than some expected. It shows that when fear lessens, money tends to flow back into quality investments. Now let's take a quick look at the bigger economic picture and some specific companies that made headlines. The economy right now has some mixed signals. On one hand, retail sales are up a healthy 7.4% compared to a year ago, and not many people are filing for unemployment. This tells us consumers are still active. However, some surveys show that consumer confidence has dipped slightly, and people are expecting prices to rise more in the next year or two. What consumers do with their money is often more important than what they say in surveys. The economy seems to be in a phase of slowing down a bit, but it's not currently looking like a major crisis is about to happen. A smooth transition remains possible if smart decisions are made. In the stock market this week, some companies had a great week, while others faced challenges. Tesla jumped 18%, partly because of news about easier rules for self-driving cars. Charter Communications was up 11%, fueled by growth in their mobile phone service. And Nvidia continued its strong run, adding another 4% as the demand for AI technology grows. On the flip side, Intel fell 7% after giving a less optimistic forecast for their business. T-Mobile also dropped 11% due to adding fewer new customers than expected. The lesson here: strong companies often do well even when the economy is uncertain, while weaker companies can struggle even in good times. So, with all this information, what should you, as an investor, consider doing now? Stay invested. Trying to jump in and out of the market based on short-term news can really hurt your long-term returns. Staying invested through rocky times is usually the better approach. Focus on quality. Own shares in companies that are financially strong, have products or services that people consistently need, and are well managed. Diversify globally. Don't just invest in U.S. companies. As we saw, international markets are performing well this year. Spreading your investments around the world can help manage risk and capture opportunities. Ignore the hype. Political headlines and constant news updates can be distracting. Focus on the real evidence, how companies are actually performing and what consumers are doing. Maintain discipline. Stick to your long-term investment plan and rebalance your portfolio regularly to make sure it stays aligned with your goals. To wrap up, last week showed us once again that markets react to actual evidence, not just alarming headlines. Businesses are still operating, people are still spending, and there are opportunities for investors who stay focused. As the investor Robert Arnott wisely said, "In investing, what is comfortable is rarely profitable." Chasing safety by holding cash might feel comfortable, but over time, the rising cost of living can quietly reduce your buying power. If your goal is to build wealth, owning great companies through market ups and downs is essential. Stay the course, stay invested, and stay focused on the evidence. If you'd like more insights like this, please subscribe to our channel. Also, we'd love to hear your thoughts on last week's market in the comments below.